Hello, everyone. I'm so excited to be interviewing Mike, the author of the Dividend Guide blog and Dividend Monk, and is the portfolio manager of Dividend Stocks Rock. So, in today's video, we got some really exciting topics. We're going to talk about the approach for building a dividend portfolio, which is so important in a volatile market like this one. We're going to cover how to protect yourself in an inflationary, volatile market like the one we're facing in 2022. We're also going to talk about high yield stocks like covered call ETFs and split shares. So, if you are a Canadian investor, a DIY investor who wants to build a lifetime of passive income, then you definitely want to check out today's video. Thank you, Mike, for being here and sharing your expertise as a passionate investor. You and your team have worked with thousands. I think like almost 3,000. Like that's crazy in Canada, and of many different Canadian dividend investors by now, and you've seen all types of markets and strategies and big mistakes. So, of course, so we've all been there. So I want to dive in, like, what's your fundamental approach for building a portfolio of dividend growth stock?
Well, first, thank you, Tracy, for having me. I think we're going to have a lot of fun today. Kind of funny because when I started investing, I was like in and out of the market all the time, just like almost like a day trader, but like every 2, 3 weeks, I was like buying and selling, and I was doing like very well. But that was, back 2003. A monkey could have probably made some money out of it as well. And then moving fast forward a few years later, I'm doing my MBA and my certified financial planner title. I have 2 kids at home, and I can't afford to spend 3, 4 hours a day to watch the market. It doesn't make sense anymore. So I'm starting to look for other strategies that will still be profitable and at the same time would allow me to get a little bit more time to myself and to spend with my family. And I ended up I was at the same time, I had like a side business buying and selling financial blogs. And I had the opportunity to buy the Dividend Guy blog and started to like, because I was reading his stuff for a while and I thought, a dividend growth investing, that could be interesting. So for many years after that, since 2010, I've like created this approach where I can use the Pareto principle, meaning that you're using like roughly 20% of your time, your energy, your resources will create roughly 80% of the result. So if you focus on the right 20%, pretty much all the job is done. So I came up with that strategy using what I call the dividend triangle. And this is not coming from any financial books or anything. It's really like 3 metrics that I found that are very useful and very powerful to narrow it down my choices to pick up stocks in a very fast way and actually very productive way, because it has been working very well for me since then. So the dividend triangle is 3 metrics. The first one is revenue growth. So we're really looking at the trend here and not necessarily the percentage, because sometimes you can have a company making a huge acquisition after 2 years and then they have no organic growth, but they just made a huge increase in revenue because they bought their competitors. So if you look at the 5 years annualized growth rate, it looks amazing, but in fact, it was just a big jump and now they're just flat and a mature, boring business that is going nowhere. So I'm looking at a trend for that. And I want a company that obviously that is thriving. I'm more like an offense is the best defense type of guy. So the idea here is if you find companies that are growing their sales, that means that they have great products. They probably invest in innovation or R&Ds, or they're making acquisition and they have like good market shares. Those businesses will do well, even if there's a recession at one point, because they're already thriving. They're already showing like high single digit to double digit growth rate. So everything goes right for them. So if they hit a recession or any speed bumps or anything, they're going to slow down, but they're not going to be in trouble. So once I found those businesses that are thriving, I want also a company that is making money. So I will look at the earnings per share trend. In an ideal world, I would look at cash flow, but cash flow per share could be very hectic because it's really what's coming in and what's coming out of a bank account. So I look at the earnings per share again for the trend over the past 5 years. That will tell me if the company has healthy margin, if they're profitable, because it's one thing to have sales, it's another to make profit. And over a longer period of time, it's harder for like creative accounting to generate like some kind of positive earnings. At one point, it's going to catch up to you. So yes, from one year to another, you can have like a jump or a drop, but over 5 years period, you can see where the company is going. Especially right now, we have like, we're talking about interest rate rising, high inflation. So you want to make sure that the company has some strong pricing power, a strong brand, and making profit. So when you combine those two metrics, so revenue growth, earnings growth, well, then you expect a company to share some wealth and increase their dividend payment every single year. So sometimes it's funny because people say, yeah, well, Mike, you're not really the dividend guy because you don't care about the yield. You just care about the dividend growth. But it's all about the dividend growth, because a high yield could put you at risk at one point because there's probably some risk behind it. If the market requests a 7% yield on that stock price, maybe there's something that you should know about the company. Maybe you should dig a little bit further. So if you have a business increasing its payment every single year, that shows a lot of confidence in the business model. It shows that the company has a robust balance sheet, because no management would put the business at risk if they thought, okay, so we're going to increase the dividend, and then at one point we're going to go default on our loans. It doesn't make any sense. So when you combine those three factors, which are the dividend triangle, and you have companies growing their revenue, growing their profit, and then growing their dividend, well, those businesses are likely never going to fail you. And if there's any market crash or anything, they will likely get less affected. Of course, stock price will drop, but at least you know that you have in hand solid businesses, and you don't have to worry too much about short-term bump roads. You just have to look at the next 5, 10, 20 years in front of you, and those businesses will be there for you as well.
Your investing style is like my motto. As I said, buy stocks that grow, 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 and make a lot of dough. That's really comes down to it. And then they'll continue on like building wealth, giving you dividends. So that's great. I love that. So simple, and it makes us so much sense, right? I just want to, you touched on a point about the yield. Now we're going to definitely dive into high yield stocks, because that's something a lot of people talk about, and we'll jump into that a little bit later. But I just want to also talk about your thought about the markets are very volatile this year, especially we're just, going, hopefully ending a pandemic, going through an endemic. Interest rates are rising, inflation's creeping up, all our blueberries and strawberries are going up in prices. So as long-term investors who've survived and thrived for the last 20 years, like you and I, we've seen this pattern over and over again, which is the typical stock market cycle. But for many, it's like could be their first stock market experience. So I was curious, what's your take on how investors can protect themselves in an inflationary environment? Like, especially we're going through a growth stock correction, or correction of many sorts. I didn't see it really affect the Canadian markets, but there's some that are getting affected. And so anyways, I was just curious how investors can protect themselves in an inflationary environment, and what strategies do you deploy in an inflationary environment, and why?
Well, it's interesting that you mentioned that the Canadian market didn't suffer that much so far, and you're right. But one of the reasons is because we are very good with asset classes that will protect your portfolio against inflation. The thing is, it comes with a catch. So the best, probably like the best asset class, the best sector to invest in if you're looking for protection from inflation is commodities and energy. The reason being, it's pretty simple. They're at the center of inflation. So when the oil goes up, fuel goes up, and then it touches transportation, and then transportation of goods has an impact to pretty much everything we purchase. So if you go at the source and you buy oil and gas companies, or you buy commodities, so you don't have to worry about the price of lumber going up, because you have like companies selling those lumber. So you're just feeling good about it. The catch comes with the high cyclical market with those sectors. So the thing is, everybody's a genius now because they all invested in oil and gas market towards the end of 2020, and they never invested before, and now they're making a killing. So kudos to those people. I was not part of them because I don't like the oil and gas sector, mostly because their entire business model depends on commodity price. And the problem is, when it goes up, there you go. You have plenty of cash flow. The dividend is raising and everybody's happy and everybody's a genius like since 2020. A lot of investors forget that if you look back for the past 5 years, the past 8 years, the past 10 years, they have not been doing well because when oil price goes down, cash flow stops. And what's the first thing that the company will cut? Well, obviously the dividend, right? Because it doesn't have any added value for the business to reward shareholders, especially if you're running short on cash. I mean, if you're having problem at home, the first thing that you're going to cut is probably the $5 or $10 a week that you're paying your kids to do like some core chores or anything. You know, that's really like one of the first plays you're going to cut up. I mean, it sucks, but it's not going to impact the future. And this is what's going to happen. So when you're thinking about it, there are other ways that you can protect your portfolio against inflation that will be a little bit less hurtful and maybe a little bit less of a roller coaster. The first one would be REITs and utilities. Why? Because they can easily pass the inflation increase to their tenants or their customers for regulated utilities. So when you're thinking, and I know big fan of real estate here with Tracy. So when you're thinking about real estate, most of REITs have long-term contract with their tenants, but it includes an escalator price. So every year they already know, both parties already know that the rent will increase by 3, 4, 5%. Sometimes it's directly linked to the consumer pricing index. So it's fully protected. So that's going to give you some kind of protection. And my favorite one is actually quite convenient because it works when there's no inflation. It also works when there's inflation, is to focus on dividend growers. The thing is, if you focus on dividend growers and your portfolio dividend increase by 5% per year, which is easily achievable if you do some research, especially if you focus on the dividend triangle, well, then you don't have to worry about inflation because every year the dividend generated by your portfolio will be higher than the increase of inflation that we live right now. So yes, we're gonna maybe have like 1 or 2 years again of like 5-6% of inflation rate. Fortunately, or unfortunately, if you have a lot of debts, interest rate will increase. It's going to slow down the economy, put some pressure down on inflation, and we're going to go back to that 2% target rate that both the Fed and the Bank of Canada are looking for. And they have plenty of tools to manage it. You know, they were slow on acting, mostly because the thing is, when you increase interest rates, it's pretty much when you put brakes on the highway. So if you're running 120 on the highway and you want to go out to that exit, if you press very, very hard on your brakes, you may never get to that exit. Maybe something's going to happen and then you're going to end up in the ditch. So you want to just slowly put the brakes on and see what happens. So this is exactly what central banks are doing right now across the world. First, they just say, oh, we're going to increase rates. Already just saying that is some pressure on the economy. And then they're going to obviously start right now to increase the rates and they're going to see how it goes. So hopefully it's going to be a smooth landing. We never know how it goes. But if you, again, focus on dividend growers, you won't have to worry that much about it. And most of those companies will have like healthy margin, pricing power. They will be able to pass along a part of the inflation to their customers. We've seen that with companies like Starbucks, for example, and who would have believed that even at $7 a coffee, you can increase it to $7.50 and people are still going to come in. I mean, that's a miracle, right? But that's the power of branding. And you have a lot of companies that are doing that right now. We feel it as a customer, which is not very nice. But as an investor, it gives you that security that if you have a plan and you focus on it and you stick to it, you don't have to worry about those short-term impact. We're not going to talk about high inflation for the next 25 years. It's going to resolve at one point. Even the dreaded stagflation period of the 70s lasted about 10 years. You know, after that, it was over. And even when people say, yeah, but there was inflation, it was like incredible because the inflation was going up, but the stock market was going down. So we're in a recession. That didn't make any sense. And it was terrible for investors. And I'm like, yeah, that lasted 10 years. Technically, even if you're 65 today, that brings you to 75, meaning that you still have another 10, maybe 15, maybe 20 years in front of you to still invest, even if you're 65 today. So keep an eye on the long-term objective and not exactly what's going to happen tomorrow morning. And if you have done that for your entire life, you're never going to get stuck in that panic mode.
It's just, I always say, like, when in doubt, zoom out, chill out. Like, right? It's long term investing. um, Touching on, you did say REITs, which is great, and obviously commodities, which is cyclical. And we definitely know what happened. Like, I just think of the 2015, 2014 oil crash. It's like, yeah. So just thinking, you didn't mention financial sectors. I was just curious, like the banks, wouldn't they also do well because they would raise interest rates, right?
Yeah,
And
you're
with
actually right. Not exactly with the inflation, but with interest rate rising, you're
yeah.
definitely right because especially banks, it has been very tough for them actually. It doesn't show for Canadian banks because they're well diversified and they were able to make money outside of just net interest income. So they developed capital market, developed wealth management, insurance. So they had like other growth vectors, but for the classic activities of like savings and loans, if you have higher interest rates, it means that your margin increase, the interest rate margin increase. So then you have more wiggle room to play around with your mortgage rate and eventually make a little bit more money on each loan. Because right now, what they've been doing for the past 10 years is to compensate low interest rate by a lot of volume. But now this volume will actually become even more profitable for them. So that's definitely a good sign for banks. And I would also throw the life insurance companies, which I definitely prefer Canadian banks, to be honest. But life insurance companies, they had a rough time with low interest rate because they have to manage those huge portfolios of premiums. So you pay the life insurance business, and their goal with that money is to invest it and make more money before you pass away and they have to pay for the claim, right? But the thing is, with those portfolios, they must invest a part in fixed income, which has not been quite a party over the past 10 years. So now that it increased, it's going to give them a little bit more of breathing room on that side. And at the same time, similar to banks, what they've been doing for the past 10 years is to diversify their business model, going a lot after wealth management as well. So offering like retirement products and consulting and planning, just to make sure that they offer like other things than just the classic life insurance premium, because that has almost become a commodity. So people, they don't care about the life insurance company, they just care about the price they pay, and that's pretty much it. So it becomes a little bit harder for them to differentiate their product. So with the advice, financial advice, it has been a little bit better. So definitely they will be doing good in the upcoming years, and we have seen those are the part of the sectors and companies that have doing pretty well actually, even since the beginning of the year. Even though the market is a bit going down, they're still highly profitable and their stock price are going up right now.
You touched on high yield stocks. A lot of Canadian investors love them, especially because they're super popular. They obviously, because they produce more income, especially if you're in the retirement stage. So one that's really popular is one that tracks like tech stocks like QYLD. And so as you're approaching retirement stage, I was curious, like, what's your take on these cover call ETFs and these split shares, which is an alternative to REITs, right? Who are also high yield, but these ones are even higher yield. So especially it looks really attractive because we are in a very volatile market. So I'm always curious, what's your take on that?
Yeah, I would start with a quote from Peter Lynch that says, know what you own and why you own it. Uh, Covered call, I'll start with the covered calls, but those are two different investment products and they're not as simple as you may think. And if you don't understand how they work, well, then you may not understand why they're being so generous and if it's sustainable, because that's the other thing. There's no free lunch in finance. So whenever there's something that looks too good to be true, you have to ask a few more questions. So for covered call ETF, in general, they work well and they generate a higher income, which is their purpose. So a classic one would be ZWB, which is a covered call done by BMO on Canadian banks. So the principle of having a covered call, what it means is you own the stock and then you sell an option to buy it. So someone else on the market will have the option to buy your shares at a specific price. So by you selling that option, you get a premium. So you get the cost of the option. So that's an additional revenue. And at the same time, if you're holding stocks of National Bank, for example, you can say, okay, so right now it trades at $100. I'm going to sell a right to buy it at 110. And then in the meantime, I'm getting money from the call, I'm getting money from the dividend, and hopefully the stock doesn't go high that fast. So nobody wants to buy it at 110 because it's still worth 105. And I keep the stock and I get the best of both worlds, the dividend plus selling the covered call. So this is how a covered call ETF will work, basically. So it's just like at a large space, but it's pretty much the same principle. The thing is, when the market goes well, you're going to leave a lot of money on the table. So if you compare ZWB to any banks, any of the big six, and I always include National Bank because it's my favorite bank. So I'm not talking about the big five, I'm talking about the big six. But even then, if you look back at the past 3 years, 5 years, 10 years, the only one that underperformed ZWB was Scotiabank. All the others did more than like let's say if ZWB did 100% over the past 10 years roughly, most of their banks went up by 200, 250, even 300% total return. So when you consider everything, so that's a lot of money on the table, and I'm not ready as an investor to leave that. So yes, you're going to have a higher income, but whenever those companies are doing great, and it's pretty much the idea, because if they're not doing great, I mean, you're buying losing companies, losing stocks. It's not exactly the good mentality for an investor anyway. So instead of having like a 5 or a 6% yield on the covered call, I rather go with a 3-4% yield with a bank, but participate fully on the growth of that company, on the growth of that stock. So overall, I mean, if you don't need that much money, and for you, the most important part is not having any headaches and not having any troubles, you can go with ETF. They're very simple. They're going to do what they're supposed to do, but just know that what you're leaving on the table is huge. Now with split shares, it's a lot more complicated. It's pretty much like putting money in a black box and not knowing exactly what's going to come out of it when you shake it. You know, it's like you're at the magic show and then you're just wondering what's going to happen. So what I mean by that is usually if you go on their website and you see what they kind of like explain it, they will tell you, oh, we have like those great blue chips in our portfolio, such like telecoms, Canadian banks, financial life insurance companies, you know, like all of those great companies that we love as investors. The thing is, they invest 15-20% of the money in the stock. The rest of the money is invested in leverage and options, and they're trying to generate a higher income because they're on that pressure to distribute such a high yield. Most of the split share offer like 8 to 10%. So double-digit yield seems like heaven, right? You mean every $100,000 that you invest, you get $10,000 back every year. You're thinking, wow, I'm going to build my retirement plan on this. And then it's like fully diversified because I have like plenty of stocks in that, great blue chips, known companies. Everything seems perfect. The thing is, when you do leverage and when you use options, it can go either way. And we have seen it many, many times with split shares. Each time the market goes up and it's going well, there's absolutely no problem. So you're going to get some good value on your shares, and then that double-digit yield. It's going to work perfectly. When the market crashes, if you look at their dividend history, you'll see that for several months they just forget to pay the dividend. They're just like, oh yeah, there's no money left because our option trades didn't work that well, and now we cannot pay you the distribution. So, and at one point I was looking at one, and it was like for 18 months there was like no dividend paid. And then you're thinking, okay, so if you're counting on retiring on that income, I bet you cannot live for 18 months with no money. And make no mistakes, while the dividend was suspended, obviously the share price was also going down. So it's a loss of income, but it's also a loss of capital. So it's almost impossible for the investor to turn around, take that money and invest it elsewhere, because that 100K that you invested may be worth 60K now, and it doesn't pay dividend anymore. And now you're stuck in that black box with no answer to this. So on this part, I would never go on split shares. Covered call, a little bit better, but then again, you'll have a better way if you do your, what I call the homemade dividend. So which is a mix of selling a few shares and cashing the dividend payment from your portfolio to average maybe like a 4.5%, whatever you need to retire, but use a mix of both, because you're better off with healthy companies paying a lower yield but a growing dividend than some kind of like shaky products. You're not too sure how it works, paying a very high yield, but at any time, if there's a problem on the market, those type of investment are the first one to cut down their dividend and to crash. And we have seen that already multiple times. It happened in 2020, it happened in 2018, it happened in 2008. So you have to be careful. And sometimes, you know, as you mentioned, there's a lot of new investors that have only went through great years on the market, because it's been like 10 years that pretty much close your eyes, you throw a dart, and then you're good. You know, if you're at least average lucky, you're gonna make money on the market, but it's not always like that, unfortunately.
I'm so glad that you did share this black box analogy, because that's how I feel about split shares too. You're at the discretion of those who are managing it, and plus you do pay fees, right? These the fees would eat you as well. So it's just as long, I mean, maybe it's your best friend who's doing it. Maybe maybe if you could trust your best friend doing it. I don't know. I just don't know what type of option strategies they're also doing. I just want to know, let people know where people can find you.
You can go to dividendstocksrock.com. That's my membership website, but we also offer a free workbook on it. It's like nearly like 40 pages where you're going to learn about sector allocation, which sector works best for you depending on your goals, how to determine how to invest in stocks, your buying process, selling process, and so on. It has like a bunch of questions to make you think about that as well. So it's like very well built for that. And we actually built it with my members to help them out. And then after that, it's like, oh, well, I can offer that to people so they can like start on their own and start their investing journey like with that empowerment. I also have a podcast, Dividend Guy Blog /podcast. So every Wednesday we have an episode on that. And actually we have an offer for all your listeners. So for Dividend Stocks Rocks, it's a membership website where you can access portfolio models. We have a newsletter, private webinars. We have like probably like the most complete dividend stock screener there is in North America, because we cover both Canadian and US dividend stocks, cover over like 1,100 companies with ratings and so on, graph analysis, everything you need to build your portfolio. And we're giving out a 33% discount, and that's a lifetime discount. So you have it this year, you have it next year, you have it in 5 years if you want, as long as you remain a member. So go to dividendstocksrock.com/FNM for financial Nirvana Mama. So we thought FNM was a little bit faster to put it. And the coupon code would be there. So it will be FNM33. So you can either subscribe to the regular subscription where you have like everything that I've mentioned, or you go pro. So for dividend, for DSR Pro, which will enable you to build your portfolio on our platform, get our quarterly report on your portfolios. We have a team of analysts that will tell you, oh, you're overweight on this part. We have like a few stocks that we don't really like their earnings, so we're going to highlight them for you. So you won't have to track news anymore, and everything will be simplified for you. So again, dividendstocksrocks.com/FNM, and the coupon code, very easy to understand, FNM33.
Oh, thank you.